about a very important concept in the financial markets known as support and resistance. Now, support and resistance is one of the most widely used concepts in CFD and Forex, crypto trading, any financial markets. Strangely enough, everyone seems to have their own idea on how to measure support and resistance. Now, the concept of support and resistance forms the basis for technical analysis. Traders look to buy at or near areas of significant levels of potential support in an uptrend or resistance in a downtrend. Now, you may have heard the old business cliche, buy low and sell high. Traders usually ask the question of how low is low and how high is high. One way we can qualify or quantify these levels is by using areas where the price has stopped and changed direction in the past. The area where price stops after moving up and then turns around is called resistance. Resistance acts as the ceiling, capping future advances or slowing them down. Resistance is not just some random area where price turns around. There are potential sellers, traders who have sold a currency pair or an asset before and remember the collective power that had to push the price lower. So we know, like when the euro is moving up, we know 121 or 121.5 is a very difficult area for the euro to get above. So if we were in the market, we might set that at our exit point because we know that point of resistance is hard to fall below. Now, when it bounces off there, we might say that the euro might go down to 120 because that's a major support area. 120 is where people will jump in because they say that price is low enough, we'll buy up the euro. And that becomes a support area. That area of support supports the price because most likely, if price comes down to that level, it will then reverse and move back up because that's a point in which buyers will enter the marketplace. Now, another group that make up resistance are the ones that bought at or near resistance and are trapped when the price fell because there's no guarantee that prices can go up or down. We expect at these levels to get some type of action, some type of reaction that'll give us a clue to the market. Now, granted, we are looking at a very easy to see chart here that happens, but it's only doesn't always happen or doesn't usually happen this way. A well-developed trend will move up and then retreat, move back up and retreat, move back up and retrace. Okay, these are peaks and valleys, or the hems and haws, or you can call them the push and ease, because an asset doesn't climb straight upward. Okay, it takes a great deal of momentum and effort to push an asset straight forward this way. A well-developed trend, push and ease, push and ease, push and ease, push and ease, and these eases create the support levels, because when price falls back down, this is the point where the buyers re-entered the market and pushed the price back up. Where it climbed up and where it started to reverse and come back down to form that mountain or that valley is the support levels. So in a very pretty self-defined trend, these are easy to see, just like you see here. We see the support level. Price in a downtrend came down here, bounced off of it, and moved back up. Okay. Now, it moved up to the next resistance level, came back down to that support level, then moved back up. This is just how it naturally moved. Then we can take these prices from these peaks and valleys, or these swing highs and swing lows, and project them forward. Because these levels will hold true moving forward. They're not just levels in time that happened once. Okay, that's why it's crucial to see what numbers in the past were critically important the last time or the times before historically when this asset was trading close to the current price that it's trading at. Now, the concept of supply and resistance, or support and resistance, I'm sorry, isn't that difficult to understand. Okay. Now, one thing to remember is that support and resistance levels are not exact numbers. Oftentimes, you see a support and resistance level that appears broken, but soon after find out that the market is just testing it. Now, let me try to explain in an easy presentation or a little story of what or how we can define the support and resistance. Now, imagine you're gold and you're trading today at 1250. I paint you all gold and I take you and push you in an elevator. Okay. Now, you're gold, so you don't have any hands, you can't push any buttons. The door closes on that elevator, and what is supporting you at that moment? The floor. The floor below your feet is your support level. And in order to move up, you have to break through your ceiling, which is your resistance level. Now, because you cannot push the buttons because you don't have any hands, you're going to stand in that elevator till the elevator starts moving up. Now, you have no idea where it's going to stop. Now, as you're being pushed up, you're being pushed through that ceiling and up and up and up and up and up. And where it stops is your next resistance level. But since you don't have the ability to control where it's stopping, it's going to stop where? Well, if you wanted to figure out where it would stop, how could you do this? Well, if you could sit back and observe. So you're golden as the elevator goes up and down throughout the day. You're just sitting there observing. You don't have any hands, you don't have any voice, you have nowhere to go. So as the elevator moves up, you notice it stops often at 12, you're at 1250, and it stops often at 1275. So when the door opens at 1275, you kind of look around and see that's a big floor with lots of doctors and lawyers' offices on it. Okay. It moves up to a couple more floors and the door opens again. It seems to open there a lot also. You notice that an apartment, complex is built above above on the top floors of the building, and that's where the people enter and switch the elevator over to the main section, and that's where they go through security and everything else to enter the apartment building. Now, that elevator you're on doesn't make any stops. It goes up past the residential area and goes up to a restaurant that's located near the roof. The door closes again, and then it goes up to the roof. When it opens, it's not the roof. It's a smoking area, vending machine area, where people that are basically working in the building go up to smoke. So now, as the elevator goes back down and goes up throughout the day, and you can start drawing conclusions on where that elevator will stop. So you think it's going to stop at 1275 because that's a point of interest, say. Okay, and because throughout the day it stopped at 1275. Now, when the doors close at 1250, you're expecting the next place that elevator is going to stop is at 1275. Now, it doesn't have to stop at 1275. There could be nobody looking, or somebody pushed the down buttons farther up, so it's going to go all the way up to the residential level before it goes back down and stops at 1275. No guarantees, but they're calculated levels that you'd expect some type of reaction. And this is basically what support and resistance are. They are areas in the past where things often happen. Buyers enter the market, sellers exit the market, or supply and demand flipped and flopped. Now, support and resistance is a common jargon for areas on a chart where price has a difficult time breaking through. Support levels tend to stop prices from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. Now, when we say that, that's not a stone hard rule. Okay. There's many support levels and resistance levels on a chart, just like there's many floors in a high-rise building. Okay. And you have minor support levels and major support levels. You have recent support levels and historic support levels. Okay. And you also have support and resistance zones. So just like that elevator, it stopped often at 1275, but it didn't have to stop at 1275. But also, if it happens to be it's a holiday or the end of the working day or early in the morning when the doctors and lawyers aren't in, there's a less of a chance it's going to stop at that 1275. During the evening, when the restaurant's busier at lunchtime, there's a more probability it's going to go up to that restaurant level. So knowing where these levels are make it much easier to decide when to open and close trades. But how can we locate these prices to begin with? Now, there's several ways that we can look for or determine what the support and resistance levels are on the current asset we're looking at the current chart. One of these is by isolating swing highs and swing lows as the price was moving in the recent past. So another great way to find support and resistance levels is to mark levels in the past where price had a difficult time breaking through. As price moves up and down, each level that price bounced off of could be a level in the future that price bounces off again. Now remember, we talk about historic prices because we don't want to just see the euros trading at 120, 150 today, and we want to look and see what happened when it jumped, it was near 120, 150 last week or 2 weeks ago. Okay, we want to see what was crucial 3 months ago, anytime that the euro was trading around that level. And we want to see historically how important that level was. Did that level hold in 1967? Did a level hold in 1987? Was that level important in 19? The more times that level was important, the more important it is now. Now, of course, the recent, the last month, the last 3 months, the last 6 months, when the euro was at that level and reacted at those levels, is more crucial. But historic levels are very important. Okay. But this is a manually intensive method and can take a long time to go back in our charts and research. Now, arguably, the easiest support and resistance levels to add to our charts are pivot points, because pivot points are mathematical calculations. And pivot points you don't have to do anything to do. Now, if you want to use what's called a pivot point calculator, it'll take you a couple seconds to drop these onto a chart, to calculate them and drop them onto a chart. But you can also get them off of what we call pivot point charts. Pivot point charts are easily accessible from all the major Forex and financial news services. They're not secret. Like I said, anybody can use a pivot point calculator. If you go on investing.com and just look under technical analysis for that asset, it's going to list the pivot points, and they're constantly updating based on price movement. Okay. Now, the pivot points will give us the support and resistance levels around the current price, and 3 levels up and 3 levels down. So we can see here for, this was back in May, but this is the euro US dollar, and we can see the 3 levels around the current price. Okay. And like I said, these are constantly updating as price moves throughout the day. Most sites are updating them every 30 seconds or 60 seconds. If you want the most instant, then you have to use a pivot point calculator. And you can also find that on investing.com, Forex Street, Forex Factory. They're all exactly the same. And you have to drop in some current price information and it'll spit it out for you quickly. But most today, the pivot point charts are fairly, they spit out prices. They're updated fairly quickly. Okay. We also see resistance 1, resistance 2, and resistance 3. These are 3 levels above and below the current price where we might expect price action. Okay. These are floors above and below the price. I just want to get these. Okay. Now, markets ebb and flow. They go up, they come down, and they move sideways. The primary ways we make sense of these movements are analyzing the price action, as well as the levels in the markets where price bounced higher or rotated lower. And we call these levels support and resistance. Support and resistance levels form the foundation of technical analysis, and they help us build a framework from which we can understand the market prices. For price action traders, support and resistance levels help us plan our stop loss placement and our profit targets. But perhaps more importantly, these levels give us a way to make sense of the market in terms of what it has done, what it is doing, and what it might do next. And this is a very good way to explain why these levels are important. So I'm going to repeat it. These levels give us a way to make sense of the market in terms of what it has done in the past at this level, what it is doing currently at this level, and what it might do next. So it gives us the past, the present, and the future. So like I said, one of the more traditional ways to find support and resistance levels and put them on your charts comes from using swing highs and swing lows. So perhaps the most important support and resistance levels are traditional swing highs and swing lows. These levels that we find by zooming out to a longer time frame, typically a weekly or possibly a monthly chart. This is where we get a bird's eye view of the market and the major turning points within it. Okay, so let's go over and actually look at a live chart. So we're going to go look at the Euro US dollar. And we're looking at the Euro US dollar in a 1 hour chart. We can see that the price is currently trading right about here at 118.039. Now, if we quickly look at this chart, we can see the euro hasn't been anywhere near this level in the last few days. So we don't even have a short-term support and resistance level to look at. Now we can pull our charts back a little bit farther, and we can see the last time it was trading at this level. Look at that. We can see a crucial price point right here. Why? When it came up to this level in the past, look at this. We had two swing lows right on that price level. We also saw the price pushed above it, couldn't stay there, came back down and fell below it. That tells us this price, and it's right just about where the euro is sitting right now, is crucially important. We also had this swing high right here, which is the highest point that the euro was ever able to get to. And if we bring it forward to the current situation, we see that this is the highest level the euro's been at in the last month, just about. So and because we can have many levels, we can have as many as we want. Let's put this on a chart so we can keep track of it. And like I said, we can call some minor, some major. So we're going to go right here and we're going to put a line across right here at that price. Okay. We're going to come down here and we're going to put another price level right here, because we know that that level, we have two swing lows. We also see the price was not able to stay above that price, and we see that was crucially important. But this is only back a short period of time. Now, the other thing we want to do is we want to switch this over to a wider term time frame to look back on our charts. So now, when we're looking at the longer term chart, we can also see the peaks and the valleys, or the troughs and the peaks and the valleys, or the pushes and eases of price. So we can see the price move down, the downtrend. Here, this level pushed down the downtrend, it retraced up here, came back down the downtrend, and this little blue trend line, that's the line from our shorter term charts before. And look how important that level was. Now, if we move it back farther, we can see all these other times it held price, was important to the price market. Also, the more current green one we just put on here. Also, look at how much congestion we had at that price line. So when we look back at farther charts, we can also find other levels that were important to this asset. And right now, the euro is still trading. It doesn't, when we change charts, it doesn't change. It's still trading just about right here. So we're only concerned right now with the levels above and below the current price. Okay. We can get many levels above and below, but we want to find the next level if the euro starts falling. Now, look how important this line is here. Now, we're going to make this one red because this is a resistance level because it's below a support level because it's below the price. When it's above the price, it's a resistance level because price to move up is going to have to break through it. When it's below, it's a support because when price falls down, we're hoping that supports. So where we just wrote that, put that red line on there, that's another crucial area of support. Now we can also find the swing low right here and call that another support level. We can also find, we look at here and we can see which prices. We can see that this price right here was also, but this was a minor support level. So I'm going to change this to a dash line, a dotted line, because that tells me it's not a major level, but it's the level that we want to look at. So now we have some type of, we built the elevator and the floor is above and below the price that we might expect price to react to. Okay, when we look at this chart, we can also see the swing high on this retracement right here and say that that is a minor level or important level, a resistance level, because we can have as many of these levels we want on our charts. Okay. If we were to bring this back to now a one-day chart, okay, all of our price levels stay on the chart. But we can then go back farther in the past and try to determine what other levels are crucial. Now look at this, when we go back farther to the past, look how this 117, 147 that we drew up here was also very important all the way back here. Look at the congestion here. Look at the bounces that the lows here. Look at the lows there. So we can see now we're going back all the way to October of last year, and we can see now that these levels held all the way back to there. If we look at the green level that we drew on the chart earlier, uh-oh, I just lost all of my lines. I don't know how that happened. Oh, there we go. So these are ways to get to support and resistance levels. We can then also go over and put our pivot point lines on our chart. For, in other words, then we can actually take multiple ones and build zones. So we can call one a buy zone and one a sell zone, or a resistance zone and a support zone, because they're not finite numbers. They are estimates or price levels we would expect some type of market action and reaction. So let's go back over to my PowerPoint. So what we did now is we got this bird's eye view of key support zones and key resistance zones. Now remember, these terms are interchangeable. When price moves above a resistance zone, that resistance zone becomes the support level. So in other words, when the elevator moves to 1275 and it's still moving up, 1275 is your support level, and moving up is the next resistance level, or the next floor of importance. Now, these levels do not have to be exact. They may intersect price bars, and they may be zones rather than exact levels. You can consider this the first step in regards to support and resistance levels. And it's the first thing you should do when you're analyzing your charts. So next, we would want to zoom down to a time frame to the daily charts to fine-tune our levels some more. The daily charts is a primary time frame for finding trade setups. Now, unfortunately, too many people, especially CFD and Forex traders, trade from 15-minute and 30-minute charts and do all of their work. Okay. Short-term charts, or your charts and your trading, should fit your type of trading style. So if you're trading, you're looking to keep a trade open for a couple hours or a day, yes, you should be looking at those short-term charts. But to be honest with you, you should be setting up your trade in a one-day chart, a longer period of chart, to see more precisely what it's doing, and then use your 15-minute and 30-minute chart to identify the exact price which you want to enter the market. Okay. So one key point to remember is that when you zoom into daily or even 4 hours or 1 hour, you always leave the higher time frame levels on your chart, as they are very important. Have you heard the old saying, old support becomes the new resistance and old resistance becomes the new support? This is referring to the phenomena of the market making higher highs and higher lows, or lower lows and lower highs, in an up or a downtrend. We should mark these stepping levels as they form. When the market breaks down or up through them, we can look to trade on the retracements back to those levels, also known as trading pullbacks. This also gives us a way to map the trend of the market. When you see this stepping phenomena, you know you have a solid trend in place. These levels are good entry points as well as points to define risk or stop loss positions. You can place your stop loss on the other side of these levels. So in other words, if you were going to trade the euro to go up and it was trading above 120, 150, and you were trading it to go up to you're hoping it goes up to 122, and the support zone was at 120, you might want to place your stop line at 119.95. So if it breaks that support zone and starts falling, your trade closes out and you get out of the market. So we can look to sell or buy at swing points, even if they are not hard part of a trend. Markets spend much of their time consolidating and in trading ranges. So we should be able to find trades within those market conditions, not only in trends. Well, remember, the markets only have three ways to go. They can go up, they can go down, and they can go sideways. It happens to be that sideways congestion, okay, or horizontal trends, okay, are where markets spend most of their time, or we can call it consolidation. Markets spend a great deal of time. You don't often find beautifully formed uptrends and downtrends. Now, the fact is, there are lots of traders who want to form these channels of swing highs and swing lows and mark them as support and resistance and try to trade in this sideways congestion. There are some strategies that you can do that. I don't recommend it because I find it very risky, because you have no idea when the market's going to start trending up or down, and these sideways congestions sometimes just bounce at random off of numbers. Now, we also have something called dynamic support and resistance levels. These levels, what I mean by dynamic is moving levels. In other words, moving averages. And you can actually use moving averages to not only we take the noise out of the market, we can use those as defined support and resistance levels. and use them to make decisions. So again, if we're trading in small terms, or we're trading Forex or CFDs, and we're just basically not a day trader, but we're trading in a short period of time, you'd want to use a very short-term moving average. And we can use that moving average going through swing highs and swing lows, or through these peaks and valleys, to determine important retracement levels. Then we also have an important level that comes from, or is associated with, Fibonacci's. Now, Fibonacci levels come from the golden mean, or the golden average, or phi, and we use those as retracement levels, which are also can be used as support and resistance levels. And it's based on the belief from Charles Dow that the markets, after they moved up, will tend to move down and retrace part of that movement up to a 38.2 level, a 50% level, or a 61.8 level. So when you draw these on your charts, okay, you can then watch those as additional support and resistance levels. So if you the Fibonacci level, we do include 50% only because it's so popular. So when we see a trend move up, and that's a completed trend, it's the previous trend, not what is on currently, we can then take that and put it on there, and we can then take 50% of that movement and make that a support level, because we believe price will tend to retrace down to that 50% level and bounce off of it. So that becomes a crucial support level. We can also add the 38.2 and the 61.8, which come from the Fibonacci retracement levels. So trading range support and resistance levels can provide many high probability entries for the savvy price action trader. The first idea is to first identify a trading range, which is usually based around price bouncing between two levels, and then look for price action signals at those levels, and look for it's a fade to the level on a blind entry. So if we do see congestion, okay, we can look for some type of way to tell us that that congestion is about to end and move into a trend. Now, the final type of support and resistance we're going to discuss today is event areas. Event areas are a difficult concept to get. Event areas are key levels in the market where a major price action event occurred. Okay. So in other words, when we saw where price bounced up and down to when it was very volatile, like when the ECB had a meeting and said something, or the Bank of England did something, or when you had the Brexit vote, or when the Federal Reserve does something in the US, and we can see this, or the jobs report, and we can see these highs and lows that were created around that event in the past. Well, we have that market high and that market low that happened. So like we have that market high and that happened last Friday when we had the non-farms payroll report. We can take that event high and low and bring them forward on our charts also, and mark those as areas of support and resistance, because that tells us when the market gets very volatile, these are the levels it might bump up to or fall below, because these levels became very important during a volatile market. So now that you know the basics, it's time to apply these basics to extremely useful technical tools to your trading. Now, we want you to make sure some easy to understand. So we've divided how to trade support and resistance levels into two simple areas, the bounce and the break. The bounce, as the name suggests, one method of trading support and resistance levels is right after a bounce. Many retail traders make the error of setting their orders directly on a support or resistance level and just waiting for the trade to materialize. Now, remember, if you understand order entry on a trading platform, means you don't have to wait for any bounce. You don't have to sit there and wait for it to be time. when you've looked at your support and resistance levels, you've isolated a price area which you would want to enter an asset. So if price is falling down and coming to that support level, you might want to enter that asset right at that support level or right below. So you can set up a limit order to open a long trade when the price hits that area, or you might open it a pip or two below that support level. So it falls down there and then it's coming back up. Okay. And you might enter your pre-existing take profit point at the next, the predetermined resistance level. Now, this may work a few times, but this kind of trading method assumes that a support and resistance level will hold without price actually getting there yet. You might be thinking, why don't I just set an entry order right on the line? Well, the way I assure you the best possible price, that way I assure you the best possible price. When playing the bounce, we want to tilt the odds in our favor, and that's very important, and find some sort of confirmation that the support or the resistance will hold. For example, instead of simply buying right off the bat, we want to wait for it to bounce first before entering. Okay. So we might set our trade when we see it coming down to the support level and say this is at $1,200 for gold or 121. We might want to put our buy level at 121.10. So it has to bounce off of this level before it enters the order. We would put our stop loss below and our entry order up here. So if you've been looking to go short, you want to wait for the bounce off resistance. So to sell, it's just the exact opposite. Then you have the break. Now, in a perfect world, support and resistance will hold forever. McDonald's would always be healthy food, and we'd all have jetpacks to fly around on. But in the perfect Forex trading world, we could just jump in and out of price whenever price hits those major support and resistance levels, earn loads of money. Well, the fact of the matter is these levels break often, and it's not a perfect world. So it's not enough to just play bounces. You also need to know what to do whenever support and resistance levels give way. And they give way as much as they bounce off of. Remember, I told you, these levels give you areas that you can expect some type of action. There's no guarantee it's going to push through or bounce off of. You need to be prepared for both. So you have one, which is the bounce when it hits the support level and bounces off of it. The other is how to react when it breaks. So now there's two ways to deal with a break. There's the aggressive way and a conservative way. So for the aggressive way, is the simplest way to play breakouts is to buy or sell whenever the price passes convincingly through a resistance or support zone. The key word here is convincingly, because we only want to enter when price passes through a significant level. So it has to be a major support level, or the 50% level, or a 38 or 62 Fibonacci level. And when it breaks that support level and goes through convincingly, not just a bar drops through it, we want to make sure that it fell way below it, or it had a couple candlesticks below it. Okay. We want the support and resistance areas to act as if it just received a karate chop, broke it through. We want it to wilt over in pain as price break through it. Okay. Imagine this hypothetical situation. You decide to go long the euro-US dollar in hoping it would rise after bouncing from a support level. Soon after, support breaks and you are now holding on to a losing position. With your account balance slowly falling, what do? Accept defeat, get the heck out and liquidate your position. Or B, hold on to your trade and hope price rises again. Now, if enough selling and liquidation of losing positions happens, not yours, everybody around the globe, at the broken support level, prices will reverse and start falling again. This phenomenon is the main reason why broken support levels become resistance whenever they break. As you would have guessed, taking advantage of this phenomenon is all about being patient. Instead of entering right after the break, wait for price to make a pullback to the broken support or resistance level and enter after the price bounces. But it's your choice. The conservative way is a lot easier and a lot safer. So closing your euros US dollar long trade at or near break even means you'll have to short the euro US dollar at the same amount. But it just means you get out as fairly even, you minimize your loss and get out of the market and take a small loss. So we've gone over the major types of support and resistance and how I use them as indications of market conditions, levels to look for to buy and sell from, levels to define risk, and as a framework to understand what the market has done, what it is doing, and what it might do next. When you combine a solid understanding of the support and resistance levels, the price action of the markets, you have formed a triumvirate for trading. Now, one of the key things to look at when you're looking at price move support, but near support and resistance, is volume. Volume should help tell you whether price is going to bounce off that support level, or when it breaks that support level, whether it's going to continue down. Volume will tell you what the masses are doing. So support and resistance doesn't have to be confusing. We can mix and match any method to create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure to test out these demo methods using our real-time demo account at cmstrader.com. So thank you very much for joining us tonight. Have a great week, and thanks for supporting CMS Trader and investing.com. Good night now.